Welcome to Speidel's Federal Tax Minute. I'm your host, Catherine Zidane. This week we're covering centralized partnership audit regime audits and why a partnership should elect out of CPAR if it's able to. We'll be covering the CPAR rules in a 2-hour live webinar on September 29th, which will also cover reporting flow-through adjustments, calculating imputed underpayment of tax, push-out elections, and more. You can get full details and register at speidel.com under webinars. The Centralized Partnership Audit Regime, or CPAR, has been in place for several years now, but it's only recently that we're starting to see significant numbers of partnership audits. CPAR was enacted to address the reality that the IRS was unable to dedicate the resources necessary to audit, assess, and collect partnership liabilities when adjustments had to be made to the partnership return and potentially thousands of partners at the same time. By shifting the audits and assessments to the partnership level, CPAR enables the IRS to either assess and collect partnership-related liabilities at the partnership level, or allow the partnership to essentially assist with the collection of tax through the use of various elections, like the push-out and pull-in elections. The CPAR audit process can be incredibly expensive, time-consuming, and burdensome for partnerships. That being said, partnerships that can elect out should elect out. A partnership can only elect out of the CPAR treatment if it furnishes no more than 100 K-1s and all of the partners are either individuals, a corporation, or an estate of a deceased partner. If any of the partners are partnerships, trusts, including grantor trusts, single-member LLCs, qualified Subchapter S subsidiaries, or other types of estates, the partnership cannot elect out of CPAR treatment. If a partnership elects out, the partnership will be subject to the TEFRA audit procedures, which were the pre-CPAR audit rules. Under the TEFRA audit procedures, the IRS will separately assess any tax deficiency against each partner. To make the election out, the partnership has to be an eligible partnership. The election needs to be made annually on a timely filed Form 1065. It cannot be made on an amended or a late filed return. The election is made by checking the appropriate box on Form 1065, which is question 30 on the 2022 form, and completing Schedule B2, which requires the partnership to provide the name of each partner, their tax identification number, and their type of partner, individual, corporation, etc. If a partner is an S corporation, similar information has to be provided for each of the S corporation's shareholders, and the partnership is required to issue notices to each partner that it's making the election out. This can be done by making a note on the K-1. Another disadvantage of the CPAR rules is that partnerships that have not elected out cannot amend their partnership returns. Instead, they have to file administrative adjustment requests, which can be more time-consuming to prepare. Partnerships should be advised to amend their partnership agreements if they haven't already done so to address issues unique to the CPAR rules. Many tax professionals assume that if they don't have any partnership clients, they don't have to worry about the CPAR rules. But if you have any individual clients who have partnership income, you may have to familiarize yourself with these CPAR rules quickly if the partnership is audited and makes either a push-out election or asks the partner if they want to participate in a modification to the imputed underpayment. This may not only impact your client's return for the last 3 years, but if the partnership has waived the statute of limitations, reviewed year partners may have to essentially recalculate their tax liability for tax years that far exceed the standard limitations period. For an update on all the tax law changes and news that happened during the year, attend Speidel's Federal Tax Update webinar on January 4th and 5th. See which topics will be covered and get registered at speidel.com under webinars. That's all for this week. Join us next time for another episode of Speidel's Federal Tax Minute.